audience whether they should come here or not, I just want to tell you we have rock stars of investment with us on this panel. And we are hoping that these rock stars are going to rock your world because they have money to invest in your startups. And if you have the money, they know how to make profits on that. They can give you good ROI. So you should not miss this particular panel. So anybody who's standing on the fence deciding whether they need to be here, I would say just come in. I'm sure we're going to make your life better here in next 45 minutes. Okay? Hi there, I'm Upasana Sharma. I am one of the board of advisory with Evolve. And I am an early stage investor from Canada. So all the cold that you're finding outside is I brought some with me. But I'm sure these very warm smiles over here will bring all the requisite warmth back. So I have with me on the panel Rajeev Menon and Yash as well as Ari. They will take a very quick moment introducing themselves and we'll take it from there. Why don't we start with you, Rajeev? Just introduce yourself, your fund, and what do you do?
So I'm Rajeev Madhavan. I run a fund called Clear Ventures. We are a $350 million venture fund. We basically have two funds. One is very, very early stage. And when I define early stage, a lot of people have different definitions for early stage. Our definition of early stage is we are the first check writers along with sometimes angels. We're not where the product is baked. We don't need to see the product even. In 80% of the cases, there's not even one line of code that has been written. Even the idea is not clear. Sometimes the idea even originates from us. So that's what we define by early stage. We do that from a fund, which is Clear 2, and we have another fund which focuses on late stage investments that we do, predominantly in companies that we have done. And prior to wearing the venture hat or the vulture hat, I was an angel investor from 98 to 2012. And I ran, and between 2012 and 93, I ran and created 4 companies. 2 of them were sold, and 2 went IPO in chip design and chip design software areas. These 4 companies were there. So I'm kind of an operator in VC garb. And I'm always telling my companies that I'm here, I understand some of the operational issues, I'm here to help. Whether you need somebody to help clean, I'm the janitor to whatever it takes to make it successful.
Now that's a real investor speaking. He knows that he needs to get everything done to get that money back, which he's investing.
Yeah.
On that note, with that thesis, Yash, you have a competition. He's ready to do anything for the company he's investing. What do you do and what your fund focus on?
Hello, everyone. See a lot of familiar faces here. So my name is Hemaraj. I'm a general partner at Benhamou Global Ventures, BGV. BGV, we focus on early stage. Our definition of early stage is very similar to what Rajeev mentioned. So typically, we have a pre-seed vehicle. It's called Arca Venture Labs, where we are the first check, typically pre-seed and seed. We write like up to $500,000 checks in that. That's dedicated to founders building from India and coming over to the US and we help them scale up over here. We have a pre-Series A, Series A fund on $120 million size. We are in our fund 5 there. And there we write up to $4 to $5 million checks in companies that are past product market fit, but they're establishing their go-to market. And we also have an opportunity fund where we can double down on some of the companies scaling up north of $10 million of recurring revenue. We can double down on some of those companies. So kind of what we realized is kind of the relationship with the founder that matters. So we latch onto it and kind of continue that journey as the company scales up. My background, engineer by training, came here for my master's, worked at startup. I was a first engineer at a wireless networking startup, built indoor wireless systems, and then transitioned to the venture capital space about 10 years ago. And when we came in, Rajeev and I are from the same undergrad school, and Rajeev was a great inspiration, having seen the type of companies that he had built. So we are following.
Just aging me. That's
but we have a great path to.
Perfect. So Yash, for you, it matters is whether you click with the founder. And the beauty is that you both have been entrepreneurs before. You have taken someone's money, grown your ventures, and now you are thinking, let's help others. Ari, what happened to you? How did you land up in venture capital world?
Hi, my name is Qayumi. I run Mindful Venture Capital. We're a new fund. We closed our first fund in 2022. We're now just literally like today going on to fund 2, so we're not supposed to talk about anything else other than I can say that. From fund 1, what was really exciting and kind of how I got here is my background's very specific. It's in behavior design, human-computer interaction. I studied symbolic systems at Stanford University, and I had the privilege of working with a guy named BJ Fogg for the last decade, where I led research at the Behavior Design Lab. It was known formerly as the Persuasive Technology Lab. My lines of research follow not only persuasive, but also consensual and mindful technologies, and that's an entire area that I'm an expert in and that I've pioneered. On the other side of that, went into early stage startups, was very successful at various ones around collective intelligence, collective wisdom, all of that. My interest is really in around not only funding interesting ventures, but what I call mindful ventures. It's these companies that are really building the future that we actually want, not just that is extremely profitable. Like obviously we want both, but I mean, it definitely feels way better when you're like, oh, I put money behind that, and it's also something I'm using every day, or I'm using every year, or like I know that my kids are gonna be using this. And so we really try to push that and push profitability in that regard. What really separates us is our selection methodology. It is all around human behavior characteristics. We look at teams, we score teams at a snapshot in time, as well as incrementally. So like we have stage-specific funding requirements, et cetera. And then in terms of the definitions of early stage, we are very much similar in that regard. So it could be napkin stage, very much from the lab to then, I would say like MVP, product, et cetera. We do really push our founders very fast though. So one thing that's kind of unique around stage specifically is that all of the founders we've invested generally have around 10 years of experience. Doesn't necessarily mean that they are very old though, because they could have been working on this since they were 9 or 12 sometimes, which is slightly interesting. But in general, normally these people have had 10 to 15 years of enterprise grade experience. And like when I say that, I mean they're working 12-hour days for a minimum of 5 days a week. So it's really more of an hour thing and a rep thing that we look for. We look at the behaviors, the characteristics, and really try to build trust early on. So relationship based.
Perfect, thank you. Actually, you gave me a really good segue into my questions, and as you said, it's teams, am I right? We all know investment is a very risky endeavor, and it becomes more risky when you have someone else's money. It's easy for family offices people, no offense there, but you're taking someone's money and they're looking to see the returns. And it becomes even a notch higher riskier when you're going early stage, because you don't know what the business is gonna happen, what's gonna happen to the startup. So Rajeev, my question is for you. You have invested in over 35 companies and you're a CEO yourself. So when you look at a venture, when they're such early stage, how do you assess what is their operational capabilities? Is this team capable of doing what they are saying they will do? So what's your strategy there?
So again, people come in different forms and shape. I mean, some are very young, but have the seasoned capability to become the leaders, right? I mean, I'm just going to give my own experience. I worked in a company for only 3 years before doing my first company, which went public. So, I have that empathy that sometimes when a new founder is coming in, he or she may not have managed a lot of people, but is capable of doing that. So you have to give the founder the benefit of doubt. Now, having said that, it's a question of the process of defining what the first product is, right? Sometimes you have a generic idea of, I'm going to do X, Y, C, whether it's healthcare, whether it is applications in tax, whatever the application areas of your building or the infrastructure place you're building, having a succinct idea of the first product is what you are trying to reach as a consensus between you and the founders. Sometimes the founders admit that I may not be the CEO for a long term, and then it's my job to see if he or she is capable of doing that. And we try our level best, and we have an honest discussion with the founders as we go through the process, right? A company is about the team you build and the people you bring into the company, and not one person. The founders play a key role in building that culture of the best technologists, the best sales management process, and the best marketing process is what you need in the company. So this is the culture that you sort of need to groom from day one into the company, which as early stage investors, we get a ringside capability of doing that. At Clear, we have done something very, very different. We have built a package on AI that helps our companies identify their customers. So for example, we have some of our customers where 70–80% of their first years, second years customers are generated truly with our AI, generating who the potential customers for these are. We also, you can use that same software for recruitment for them. It identifies for a given talent what, how, then we, as VC, sometimes they figure out that, oh, the person responds better if a VC says, oh, we have a company, we would love to get your opinion. We will cast the email in that fashion, help the founders recruit the talent, right? So we go in with a small operational help that they need, because many of the founders you find are great technologists. They may not have done a lot of sales, they may not have done a lot of marketing. And the challenge for the first 1 or 2 years is to feel who is the buyer for this product. Does it fit the MVP that you had defined? And you are better off pivoting very early on versus pivoting much later in the process. So what we do with our team is help them find the first few customers, sit in those meetings sometimes, help them be like I'm often the sales guy in some of the first meetings. And the idea is to make that pivot happen in the first 6 months. And if you make that happen, and during that process you understand that this founder is very capable of grooming himself into being the leader, or do you need somebody? And for an early stage investor, not having that relationship where you can openly discuss these topics is almost a no-go. You have to build that trust in the founder that I value you, but we want to build the best company, and that's your goal too. So it takes a two-way street, and that's the kind of relationship that you have to build in the first 6 months. If you do that and you find the product fit, and many companies we have had pivots, no doubt, but I would rather pivot with our money than having taken somebody else's money who's much later stage investor and is more rigid in their thought process, right? So we are capable of dealing with these pivots, whereas some late stage will not be able to deal with that. So work with them. We have built our own software stack to help them identify this. And we have like 4 or 5 people helping them deploy these things at various customers and begin to understand. Our job is to teach them how to fish, not do the fishing for them. So we just figure that out and we get out of the way, basically. So the first round of that definition of the product is probably the first 6 months to a year. And within that first year, you end up having a prototype. Sometimes the companies surprise you and can build it in 3 to 6 months, and all that is great. So the investment we do is probably anywhere in the range of $500K up to $5 million. I mean, sometimes we get lucky that we have a founder who's a repeat founder, or he was my customer for 10 years at Magma, and I know how well he can deliver. So in which case, we have taken the first check to be up to $7 million in one case, right? Because we were making a risk on a known person who's repeating it for the second time. But when you do it for the first time, you may have to kind of go through a tranching process. But it's about building that trust and relationship that you need to do, where the founder sees you as very much in his camp, and we building a common company, right? And that's the focus that we do.
Yep. I think so for Yash, it's, for Rajeev, for you, it's focusing on, can they fish? Look at the founder, what they want to do, make them sure they understand their strengths and their weaknesses, and also make sure that they understand what their product is. That's a lot of work. You're putting your money and your time.
Yes. So this is something very interesting, right? I mean, so I do probably, as a fund, in our fund with 3 partners, we do 4 to 6 investments a year. We can't do this so we're probably seeing hundreds of companies a year, 150 to 180 companies we see a year consistently, and we pick 4 to 6 because we have to put in the effort to do this, right? I mean, this is not a no-touch model. It is helping them figure that out. and much of our companies, after year 2, we are just attending the board meeting, and I'd love to get to that position as quickly as we can. But you need to make sure that you're getting there in a fashion where the product is sustainable and you have the growth to warrant the subsequent rounds.
Sure. Yash, my next question is for you. Do you believe in Rajeev's philosophy, an early stage investor, that roll up your sleeves, get ready to get dirty in there, get into the ring, and bring your time and energy? In your experience as a long-term B2B enterprise software investor, before you roll up your sleeves and you said, okay, I'm going to give my time, what are the key indicators that you look in a company to see, is this even viable? Is this business going to work? Is it going to be a long-term success for us? What is that takes you, yes, that's where I'm going to put my money?
So absolutely. So I'll answer the first part of your question, which is, do you believe in this philosophy? Absolutely, right? All of us in our partnership have been on the operating side. All of us are also immigrants. So one of the things about BGV is a lot of our founders are building teams in Israel, France, India, and we are helping them make a transition. They're all enterprise companies. They're making a transition to the US market. And several aspects are very, very important, when you're an enterprise company and you're an immigrant. You got to empathize with them. And being that operator, being that immigrant, really helps us connect with the founder. Because this is not a lonely journey. It is something that you have to partner with those founders and help them navigate that journey. And one of the founders told me this, it's like, you have to go through 10, 15, 20 things as a founder. It's not just one thing, right? And as a leader, you have to hire, you have to motivate them, you have to go talk to those initial customers. In the meanwhile, there are lawyers working on your documents, you got to review them, and you have investors that you need to talk to, etc. So our philosophy is that if you can make those 10 things 10% easier, right? 10 things 10% easier, you have made the life of the entrepreneur 2.5 times easier. So this is the superpower, right? And when you look at venture capital, right? Venture capital was about this. It's about you pick a founder who resonates with you, who you can work with, and you roll up your sleeves and work with that founder. Somewhere in the last few years with the 0% interest rates, it all became about throwing darts on the wall and making bets. As many people still in the venture industry think that that is the right way to go about it. But our philosophy is about rolling up your sleeves and working with the founders and being their partner at every step of the journey. And this journey changes as the company evolves, right? In the early days, it could be, hey, look, help me connect, 2 to 3 early adopter customers. And we have 120 corporate relationships that we curate. And we are like, don't talk to this 90, but talk to these 10. And those are the ones that can really give you the right feedback for you. Right? And they are looking for a solution similar to what you are building. So those are the type of help that we kind of, guide the founders on. It may be around now I'm ready with the MVP and I need to bring a sales hire. And so many times, it is the opposite conversation. It's like, look, do not bring the sales guys. You're not ready for this. Let's kind of, help you refine that initial sales strategy. Once you're able to get to 5 to 10 customers, that's when you hire. So it's all of this, little coaching and nudging that you'll have to do. And for that, what's most important is that you should be able to resonate with the founder, right? So that's kind of the answer about how we go about doing what we do. And you asked the second part of the question is how do you, if I'm not mistaken, how do you assess the whether this is the right opportunity, right? So this is where, it's a constant process of 3 elements, right? One, you're continuously meeting the founders. You're continuously getting an assessment of where the opportunities are for innovation. What are the pain points that you constantly hear from a new crop of founders coming up? 2, you're also talking at the same time to several of your corporate partners, where you're kind of constantly getting feedback from them saying that, hey, look, these are our pain points. And three, you're talking to a whole group of advisors, operators who are in the operating zone right now, and they're constantly facing some of these problems. Our goal is to kind of take all three of them and build an investment thesis around, hey, look, this is the place where we want to place our bets. And that's where we start, right? And the more refined we are much better off, much more productive working with our founders, because we are not then wasting their time.
Yeah.
We can very quickly say, hey, this is not something of interest for us. Go talk to these guys. They are looking at this. We are looking at something else, right? So it helps make our time more productive. And then you start to understand, okay, now that we are in the same zone, whether the founder has lived that problem. That's the second thing I look for, is that that actual experience. Mm-hmm. And the third thing is whether they can tell that story. So many times I'm sitting there, I'm with the founder on the other side. I'm telling the founder, assume I'm a customer and walk me through the pain point that your customers face. And I look for that ability to tell the story, because it's the stories that motivate your customers. It's the stories that motivate your team members, right? Once you have that in the early stage, then you can make faster progress. So that's kind of how I go about the evaluation process.
That totally makes sense to me. So one thing which Rajeev and Yash has made clear to us, early stage investing is more like starting dating. First you assess who they are, figure out their good qualities and bad qualities, and then you're investing in a long-term relationship. Ari, this becomes even more difficult for you because you are talking about infrastructure, healthcare. The relationship is going to be forever. So if these are the sectors you are dealing with, what your fund looks into or your investment thesis is, this long-term relationship, is it going to work for me? Is this early stage startup in the sectors which is highly competitive, requires a lot of investment, and the ROI is going to come forever, we don't know when? What do you look at to make sure that you're making the right investment?
Yeah, great question. Also, just as a recap, so we do infrastructure, healthcare, and financial services. I think I left that out when I did the intro. So very much, we kind of play between deep tech and enterprise. What I really love doing is going into a deep tech company that thinks they're only hardware and then moving them to a hardware software solution and then software solution. It is super exciting because in deep tech companies, you generally only see returns minimum 7 years. But in some of these, we're now looking at like a 3 to 5 year horizon. And then after that, it's just, kind of a straight uptick. It's not even a J anymore, really. But yeah, so things that we look at, I want to focus on two things relating it to the other conversation. So one, very much agree with you on, I think some is operating focused, some is allocation focused. From a venture capital model though, like if you think about how venture capital is broken, the hardest thing is, can it scale? Can we allocate at scale? Can someone give me $6 billion and I can actually continue to allocate? So I'm obsessed with that problem. That is something I think about day and night. That drives how I then challenge our founders, because we will only back founders that are building in markets that are a minimum of 1 trillion in terms of they can actually tap it. The things that we are specifically looking for industry-wise, they don't change for one segment of what I look for. So I hyper-focus on the onboarding. What is their logical progression of how they believe the behavior sequencing needs to be structured for the onboarding of their customers? The next one is their matching algorithm. How are they actually matching their customers to whatever the service is that they're offering? Like if it is a marketplace, you don't always have marketplace solutions, but the reality is like a product is essentially just roll-ups of little service offerings. And so you do need to understand how to do the matching algorithm there. The next part is more of a framing thing, and to your point in one of the first comments, a lot of these early stage founders, they are fantastic technologists, but they are not salespeople. So them framing whatever words they're using to describe something really needs a lot of work, and it's invaluable to have not only, well, capital is actually also valuable too, because at this part, it's like you want them to build and not necessarily do the sales at the same time. Having someone, like you there to offer, sitting in on a meeting with them, helping them with that sales part and baby stepping them to learn how to fish while they can still spend 80% of their time actually building, you get a really high ROI as an investor. Because now all these things that are kind of like water for you, you're just slowly doing that. They're learning and adopting at a rate they can without it completely killing their business. That's very important to us. So we are also looking at, do we have founders who know that about themselves? Like, do we have founders who walk in and think, hey, I'm actually really good at this, and they're really not? And like I want to be better at this, and like they really shouldn't want to be better at that for whatever reason, depending on their business model. We look at those main things in the first part, and then the last part. This is the more recent one. This is kind of the R&D thing, but just because random people are here and stuff, and if you're any of you are founders, we're really focusing on celebrating. Sounds weird. It's also something that I struggle with just as someone, I like always am pushing boundaries and whatnot, but having these little moments, also doing it in your business is really important for your customers. Like it actually helps the customers realize like, you know what? I like your platform. I am loyal to you. I want to be rewarded. I am being rewarded. Yay. And then in that small moment, whatever it is, it like reminds them throughout their daily life. And it's like you only spent maybe $5 doing that, but that is like that $5 somehow will net you like, you know, I don't know, 500 plus. I don't have the exact numbers yet, again, R&D, but those numbers have been very interesting. So I'm really focused now on kind of this behavior sequence with a celebratory thing at the end, and how do we work that into the UI UX through the onboarding process.
Perfect. Now, I think so you all made very clear one thing is that in your experiences when you're dealing with these early stage tech companies, they're all good tech people, but they might not know marketing, sales. But other than this, Rajeev, what are the other common pitfalls you have seen in most of the early stage technology companies, and what are those challenges, and what you have seen has worked to overcome those challenges as well?
So sometimes the technologists that come to us will have a fixation on some particular solution that's driven on past experiences. So for example, there will be like a lot of AI application in commerce. They can relate to commerce because they see commerce on a daily basis. And there's like 30, 40 companies that come, which has no basis to be in being a startup, but it's going to pitch you a commerce company, right? So you got to think of what is the differentiation you can add, and it's a sustainable differentiation that you can continue, right? So we have two models that we operate, right? One, we have founders who will come with their own thematic ideas on what it is.
Yep.
And we help them go through. That's actually very nice that we're the lucky ones if we get that. The second one is we have our own thematic spots. One of the things about being early stage VC is you get hundreds and thousands of ideas in various pitch. So you get to know, and that's the best thing about being a VC. I can complain 20 things that are negative about being a VC, but I can tell you the best thing is you're being taught a lot of new areas by a lot of very good entrepreneurs.
Yep.
So we kind of have a thematic idea that we go off and we come up with every 6 months and say, this is what we want to actually invest in for the next 6 months. It changes every 6 months. It's very lucid and things keep moving. So within that 6 months, we have then a software which says, okay, in this area, the ClearConnect software that I said, it identifies people who may be gainfully employed at Apple, Google, all those places. We would call them.
Okay.
That's our second model. And we would get them excited, interested to go and think about it and come back. And some of them will come back. So the question where they may get stuck is they get stuck on the initial value proposition that they think is the greatest thing.
Yep.
And do not realize what the total market potential is. At the end of it, we're looking for markets that are outsized and can grow outsized. If it doesn't, then you are going to be, being a top dog in a market that's already confined doesn't excite any venture capital, especially follow-on funding. So you need to really focus on what is the value proposition that you're doing. And during all of that, sometimes the founder comes in and he or she knows that my job is to make money here. It's not just the technology.
Yep.
That's when I make money, if the company makes more money. I mean, it's the same with us, right? We don't have restrictions in our venture fund on, we have done infrastructure, finance, we have done everything. Because as far as I'm concerned, my LPs, which are, university endowments, charitable trusts, etc., they don't care whether I sell an RV or my companies do greatest technology that changes anything. Their game is to make money. That's what the CIO is all about.
Yep.
So he or she is rating me entirely on my returns.
Rajeev, just bring the mic.
Entirely on my returns. So it's very, very important that we focus on making sure that the companies that come in, the founders, thinks about what is the total available market for this idea?
Yeah.
How am I going to grow it? And is it attainable for me? And that's the second question after the idea is great, right? I mean, that's the second question that you need to kind of go through the diligence process on. And, you know, I always say this, 100% of zero is still zero. Many founders do not hire the right talent and give away their shares. It is important to have a culture of building a team, which in Silicon Valley means attracting great talent who are being paid exorbitant rates by Googles and Microsofts and everybody, at bringing them in at a much lower salary, but giving them the ownership that gives them the pride to come to your company. I do see sometimes founders who are stingy as can be, and that doesn't work. Ultimately, you're building a team, and everybody will know everybody's shares by the 6th month, if not the 3rd month. And once they start realizing that, this is not going to help the founder as well, right? So it's important to realize I'm building a team, I need to build, so does the founder pass that test?
Yeah.
Those are the questions that we spend a lot of time and energy thinking about, because if they don't, then at that early stage, you haven't built a company, because the company in the early stage is the talent that you've created.
Yeah.
Right. And if you fail there, everything else is a write-off that you can immediately think about, right? So it's very, very important to hire the best talent, recruit them, and have a very clear, focused approach on dealing with the product.
Yeah. In fact, when we invest, we always tell our founders one thing: don't fall in love with your solution, fall in love with the problem. Because if you understand the problem and you're passionate about it, you'll continue to find solutions, and when you're finding the right solution, people will pay for it. But if you're going to stick to your solution, it's not good, that's where you're actually starting the thesis of your failure. I'm going to come up with a very slippery slope question for you, Yash, and I'm putting you on a spot. We know that you said as an early stage investors, you have to be in them in the ring, figuring out if their product market fit is okay, do they know their product? How do you balance that you're still a VC, you're investing your money, but you are not the founder, so you don't trample their vision, what they want to do? I know Vinod Khosla always says, VCs should not give advice, they don't know anything. But as an early stage investor, you need to be with them. So first, my question is, how do you balance that you're not trampling the vision, what the founder wanted to do, just because you're bringing your money? And if you can give us an example, like there was a company where you were planning to invest and there was an issue, how you helped them strategically sort that issue, which helped them grow. So if you can answer these two questions for me.
So first of all, when I go into any founder discussion, I assume that I don't know much. Right? You're there for education. You're going to those meetings to learn. And I also expect at the same time the founders have that learning mindset. So when I do evaluation of the founders, I'm not looking at a lot of things, except I'm really kind of seeing, okay, can this person learn? And learning is not just listening to us, right? But learning from their customers, learning from their team, and learning from the advisors, the investors. So when you have that learning mentality,
Yep.
you solve 50% of the problem already, right? Because you don't need to go and tell them, because they already know. Second, when I talk to the founders, I typically, let's say they're heading, in my opinion, let's say they're heading in the wrong direction. Even then, I don't tell them that you're heading in the wrong direction, because I may be wrong.
Yep.
I may have some data points. And most of the times as VCs, what advantage that we have is we are covering a lot of breadth. We are meeting startups that are building to where the puck is going to go in about 5 years. Mm-hmm. We are talking to entrepreneurs who have built businesses and who are exiting them. We're trying to bring them as LPs. We are talking to corporates who are co-investing with us. They're talking to us in various different, problem areas, etc. Some of them are LPs in our funds as well, right? So we bring that broader perspective, and the entrepreneurs typically are going very, very deep in their solution set. So my approach to those founders is, hey, look, this is what I am observing. What do you think? And then ask those probing questions around why not? Why do you believe this is the right thing? Or what am I missing? Right? And it's in those dialogues. It's in those dialogues is where you discover the real problem or real approach to solving those problems. So that's the method that I follow. And the last thing is, systematically what we have done at BGV, we have 3 to 4 forums that we have created. One is Sales and Marketing Forum, which consists of people who are in the sales, marketing, customer success domains, finance domains. Second is the Technology Advisory Circle, which is folks who are in CXO roles, in CIO, CISO, VP of Engineering, CTO type of roles. And the last thing is Customer Advisory Boards, which includes AI experts from various different industries. So what we do is when we fear that, okay, this company needs a pivot, or maybe the go-to-market is not working out, etc., we try to put a founder in a group of experts. Okay. So it's very interesting to see, like, when there's one company presenting to, let's say, 8 to 15 experts, you see the problems kind of, get dissected, and you see that engagement between those experts, because they all have faced that issues before, etc. So we let the community, curated community, kind of, help the founders figure things out. So sometimes it's best to take ourselves out and let the founders hear from other practitioners. So these are some kind of, methods to kind of work with the founders.
Listening to you, I think so you have mastered the art of balancing relationship. I'm sure your wife will be happy. Seems to be giving space to everyone. If you don't want to answer, get other people. They'll tell the founder what to do. Basically, you still want to make sure they do, but others tell them. So you're the good cop. I love this strategy. Maybe everybody should look. It's going to work in your investment. It's going to work in your marriage life. I can tell you that, and that's the reason he has got all the glow. But I'm going to come to you, Ari, on this point. So he knows how to get the things done. He has strategized. When you are investing in a company in infrastructure or healthcare or financial services, how are you assessing their scalability? Is it even viable? And how does that plays into your thesis of investment? And just before you answer, if we see all the amazing crowd at the back, the reason is next on the stage is coming a legend. So please don't leave it. Once we finish the session, keep sitting. We have John Chambers coming after that. Ari, back to you.
Cool. Okay. Well, yeah, when we do scalability stuff, I mean, like, again, we're looking at behaviors. So is this a market where not only is it something that people are saying they want it right now, but actually they're wanting it with increasing velocity over time? And I actually want to revisit something both of you said, and I wanted to wait and make sure that it continued to be a theme. So both of you were talking, so there's Rajeev and Yash, they kept mentioning about motivation, the word motivation. Totally cool. We actually hyper-focus on ability very early on. And so in my world, there's like the Tony Robbins people where they're like, yeah, like hype. I actually don't like that at all. Why? Because it means my retention rates at some point in the future are going to go way down. So that's like not something we care about. In fact, I make it really hard to get my money, as well as like I make it so that the founders are actually like, Ari, I'm so annoyed at you, but I actually need your help. Like, please just invest in us. So like, we don't have that much money to invest from Fund 1. It was a $5 million fund. For people who are like, they're raising these like 70, like 80, sometimes like $300 million rounds, and they're like, Ari, you know what? We just really want you on the cap table. Can you just put like 50K? We'll take you at 50K, please. That's a pretty cool situation to be in. So like when that comes, then I'm like, okay, I'm going to assess your market now. When I'm looking at how they're actually then doing, as I mentioned before, right, the matching, the onboarding, the framing, we literally look at, for that one customer success journey, so like CUJ, like customer user journey, whatever, people have different words for it, but the journey that customer is going through, at the very end of it, not only the celebration part, but are they doing a word of mouth marketing? Yep. And to what person, at what adoption rate, is the retention above 90%? So for our portfolio companies, our average retention right now for their customers is over 90%, and it's growing like month over month, normally double for basically all of them. For a few of them, it's like over 4x, and that's like really exciting, right? The reason that we have found that right now, again, it's 2 years of that data. Prior to that, it's like 10 years and 15 years of data, but from this fund series, it's really because of the word of mouth marketing, and that this is a behavior that at high velocity, when someone says, you know what, that's actually a problem for me too. It's not about the solution, as you mentioned before, it's about the problem. They're like, this is a pain, I want it to go away. And then the other part, though, that makes it super sticky is when it's a joy. When it's something you're like, I didn't even know I could feel that way. And then when the other person that they're going to, if you have some kind of, I don't know, like 50% that they recommend the next people are the pain people, but then the other 50%, at least like one of those, ends up being a joy person, that joy person sometimes will generate upwards of like, so like 150% then of that, so 3x, whatever the original is. So we're generally looking at the adoption rate when you do a survey word of mouth, and then when you actually put a price point on it, they still adopt it, and then they go recommend it to all these other people who are like, yeah, gobble it up, share it to a bunch of their friends who are also high adopters.
Sure.
Yeah.
Thank you, Ari. That makes sense. I have a very difficult question for you, Rajeev, now. We always say that our investment theses are based on our learnings and experiences. We lose money and we learn from it. But in this era where we are, where technology and trends are becoming obsolete by every second, whatever we have learned might also become irrelevant right now. How do you keep pace with the emerging technologies in the sectors that you're investing? And what are the current trends you're looking at? Because you might like something now, and by the time you take a decision of investing, AI has taken over that. So how are you keeping pace with this fast-moving, technology-driven economy we are in?
So I'm going to give you an example of a company we invested in, just not going to name the company, but they had built a small AI model solution. This was in 2018. The Transformer paper had come out in 2017. We got a presentation from the OpenAI team in 2018. And in 2019, called the team. Mm-hmm. What you're doing is going to be irrelevant if you don't change and pivot now. So we started the pivot then. The founder will acknowledge and say that's the best contribution Rajeev did for the company.
Okay.
So in reality, we get to see the next wave of things a lot faster than anybody does, right? We did a company called Robin.io. Kubernetes for databases is what it was. It was a kind of, okay, and the database was Hadoop. Hadoop was going away. We were on the complete wrong track. But within 3-4 months, we knew that was the case. And we jumped in and we said, look, we need to pivot. Here's where we see in the market. So that's where your contribution from good early stage investors are. This is exactly the problem that good early stage investors can help solve. Okay. A lot of early stage investors cannot and is not into that. Like I going to meetings to learn with all the founders. I take a lot of meetings and it's learning. And when you see something that's obvious, that'll hurt 10 companies, letting them die and get hurt is the worst thing I could do, right? So essentially being able to communicate to them saying, this whole new model is about to arrive. You need to be ready for that, right? So in the AI world, for you to be in the edge of things, you need to know what's happening in some sense.
Yep.
Right? So you have to talk to all the big companies, large, small companies, and spending time to do that is one of the essential things that I have to balance my workload with.
Exactly. No, I love Rajeev. I send you a problem, you say that's the solution I have. That's how I solve the solution. You know what? In the same note, Yash, if we know that technologies are changing so fast and you're trying to invest in a company, how much is the scalability of the technology is an important factor for you to invest in that company? We are wrapping up. These are the last two questions. So how much is the scalability the most important thing for you?
So 100% important because, especially I've been in situation as an operator where we have built the platform, we are getting ready for scale, and then we take a 2-year pause, literally 2-year pause, because the scale of use has skyrocketed, and then you're having to limit the customer base. So, right? So, it's very, very important, and that's where you see the importance of the technology team, right? Because you have a problem, but you need to solve it in a scalable way. Otherwise, you'll hit these roadblocks.
Perfect. Now, we have the last 1 minute, because one last question for you, Ari. Before you leave, if you have to tell someone to be an early stage investors, why they should become one? One last question and we're ready to go.
I think because you're basically always on the cusp of whatever is coming up next. And so quite frankly, you sleep better at night because you just know what's coming up to the point where you're not really concerned when anything irrational happens in global markets. You're like, cool, not going to impact me. I'm an early stage investor and I'm going to be able to see what's coming before you are. So I think that's why, is that your portfolio is much more stable than these other people at like Series C onward.
Thank you so much, Yash, Rajeev, and Ari. If you have your own money, you're ready to get your hands dirty, and you're happy to know what's coming next, which can give you more money. That's what an early stage seed investors are. This was an enriching panel for me. Thank you so very much. I request you not to leave because John Chambers is coming on the stage now. Thank you so much, everyone.